Welcome to an Introduction to Accounting, brought to you by Parkbench Tutors and narrated by David Hopcroft. In this podcast, we shall continue work with cost volume profit analysis and look at a worked example for a problem. We will start by refreshing our understanding of what we mean by break-even point. At break-even point, there is no profit or loss. The total sales revenue is equal to the total costs. Since total costs include fixed costs and variable costs, this means that total sales revenue is equal to fixed costs plus variable costs. If the number of units of output at break-even point is B, then B multiplied by sales revenue per unit equals fixed costs plus B multiplied by the variable costs per unit. Therefore, B multiplied by sales revenue per unit less B multiplied by variable costs per unit will equal fixed costs. We can simplify this to B multiplied by the sales revenue per unit less the variable costs per unit equals the fixed costs. Finally, we can rearrange this so that B equals fixed costs divided by sales revenue per unit less variable costs per unit. The number of units produced at break-even point then becomes the fixed costs divided by sales revenue per unit less variable costs per unit. But this latter is the contribution margin. So, the number of units produced at break-even point is equal to fixed costs divided by contribution margin. Now we can start our worked example. The data given is for a ticket company with fixed costs of £60,000, a unit selling price of £12, and the range in question is 4,000 to 12,000 units for sales. With only this information, we can determine all of the following: the break-even point in units and sales, number of tickets to sell to earn £30,000, profit if 8,000 tickets were sold, the selling price needed to make a profit of £30,000 from selling 8,000 tickets, and the number of additional tickets we need to sell to cover the cost of television advertising at £6,000. So let's get started. To find the break-even point in units and sales, our break-even point in units equals fixed costs divided by the contribution margin. So, the contribution margin is sales revenue per unit, £20, less variable costs, £12, which equals £8. Our break-even point in units we obtain by dividing fixed costs of £60,000 by the contribution margin of £8, which gives us 7,500 tickets. To express our break-even point as sales revenue, we need to sell 7,500 tickets, each of which sells for £20. So 7,500 multiplied by 20 gives us £150,000. Now, the number of units required to achieve a level of profit. Our target profit was £30,000. We know that the contribution margin is £20 less £12, which is £8. Our sales in units will be equal to the fixed costs plus the target profit, divided by the contribution margin. This is 60,000 plus 30,000 divided by 8, which comes to a total of 11,250 tickets. How much profit will we make if we only sell 10,000 tickets? Our profit is equal to the units sold multiplied by the contribution margin less the fixed costs. The contribution margin per ticket is 20 less 12, which equals 8. So the total contribution is 10,000 multiplied by 8, which gives us £80,000. Our profit is then £80,000 less the fixed costs of £60,000, which gives £20,000 profit. Now suppose we wish to work out how much we need to charge for a ticket if we want a profit of £30,000 from sales of only 8,000 tickets. The contribution margin per unit equals fixed costs plus profit divided by the number of units sold. The sales price will be the contribution margin per unit plus the variable costs per unit. The contribution margin per ticket is 30,000 plus 60,000, which is 90,000. Divide this by 8,000 and we have 11.25, £11.25. We now have to add the variable costs, which are 12, so 11.25 plus 12 equals £23.25. If fixed costs were to increase by £8,000, then how many additional sales are required? The additional sales in terms of units are given by dividing the additional fixed costs by the contribution margin. The contribution margin per ticket is 20 less 12, which equals £8. The additional sales required will be 8,000 divided by 8, which equals 1,000 tickets. The contribution margin ratio is equal to the contribution per unit divided by the sales price. There are two uses. The ratio indicates the percentage of each £1 in sales that is available to cover fixed costs and to provide profit. If fixed costs are divided by the contribution ratio, then the break-even point in pounds rather than units is obtained. The margin of safety is a calculation to measure risk. It represents the amount that sales can decrease before a loss occurs and can be expressed in units of production, in sales value, or as a percentage of sales. It is a way of representing the difference between budgeted sales and break-even costs. From our worked example, if the break-even point is 7,500 tickets and the budget is 10,000 tickets, what is the margin of safety? In units, the margin of safety is simply 10,000 less 7,500, which equals 2,500 tickets. In terms of sales, 10,000 multiplied by 20 equals £200,000 of sales, and 7,500 multiplied by 20 is £150,000 worth of sales, so the difference is £50,000. This is the margin of safety in sales. As a percentage of sales, the margin is 200,000 less 150,000 divided by 150,000 and then multiplied by 100. This gives us 33%. This means that sales would need to decline by 33% before the company started to make a loss. High margins of safety are considered a good sign for a firm. This ends our second podcast on cost volume profit, brought to you by Parkbench Tutors and narrated by David Hopcroft. Thank you for watching and for listening. We wish you success in your studies. For more information on Parkbench Tutors, please visit parkbenchtutors.com.